the US Treasury market starts to completely implode. Donald Trump's economic bravado is crumbling as the Treasury bond market teeters on the edge of implosion, sparking fears of a full blown balance of payments crisis. Over the past 2 weeks, China's currency devaluation and potential bond dumping have ignited a full blown currency war, driving the US trade deficit, where China accounts for 29%, into chaos, while the MOVE Bond Market Volatility Index hits a staggering 171, signaling bond market volatility not seen since 2008 or long term capital management collapse. With the basis trade likely unwinding, yields on the 30-year Treasury spiking 67 basis points since Sunday, and safe haven assets like yen and gold surging over a buckling dollar, equities and bonds, the Fed's grip on the long end might be slipping. Is this the Mar-a-Lago Accord's first casualty? So today is pretty crazy. Started off with the bond market seemingly starting to implode overnight. So here we see the dollar on the left, the U.S. 10-year yield in the center, and the 30-year over here. And this is the yield, the interest rate on these bonds. And I highlighted in red a couple portions that I think are notable. So first, you see this portion here where the dollar was selling off, and what was happening here? Rates were rising. That means bonds were getting sold. Rates were rising, on the 10-year, the 30-year. Meanwhile, the dollar was actually down. Then overnight, what we saw was this incredible move higher. We've been talking about the rates on treasuries for many days now. This move was, on par with what we saw on Monday. The 10-year moved 34 basis points higher Tuesday overnight. And at that same time, we saw the dollar sell off pretty sharply. There was another kind of brief moment where the dollar sold off here. Rates moved higher, aka bonds were getting sold. And now, of course, Trump just minutes ago reversed course on tariffs, except for China. So there's a 90-day pause on the tariffs, except for China. In fact, on China, he's raising the tariffs. Yesterday, it's hard to keep up, but yesterday he had raised the tariff to 102%, I believe, 102, 103%. And then today it gets raised even further to 120%. So I want to go over, there's so much to cover. There's so much to cover. So I want to go over balance of payments crisis. What is it? And was the U.S. starting to experience a balance of payments crisis? And I want to try to paint a picture of kind of what's going on and where we're likely to go from here. So what is a balance of payments crisis? This is when a country can't meet its international financial obligations. And this is due usually to a deficit in its balance of payments. This typically arises from excessive borrowing, trade deficits for the U.S. We have both of those. We're a twin deficit nation, and or capital flight, which the U.S. has also clearly been experiencing, and we've been covering that extensively. And what happens is the country, the U.S., the country experiencing a balance of payments crisis, might have to devalue their currency. There might be inflation. The central bank might need to radically increase its balance sheet. Loss of confidence, potentially recession. This is an emerging market phenomenon. And something I've been saying for maybe a year and a half is that the US is going to behave much more like an emerging market than most US investors would like to believe. And I believe that has proved pretty accurate. So I want to cover, I did a post on balance of payments crisis. And overnight, someone had replied to Lynn Alden, linking my post. But Lynn Alden basically agreed, and in Lynn's own words, said that the U.S. was starting to experience a balance of payments crisis. Here we go. So what are some characteristics of a balance of payments crisis? Balance of payments crisis, widening of the current account deficit. Now, remember, within the current account deficit, there's kind of two main accounts for a country. There's the current account, and then there's the capital and financial account. The current account, the main component is the trade deficit. For at least for the United States, the vast majority of it is the balance of trade. And we know that the balance of trade started to blow out completely in January. And the trade deficit is just utterly insane. It's 130 bill at the time that I wrote this, it was 131 billion. I believe it's improved marginally to like 129 billion per month. So we know the current account deficit, is started to become a significant issue earlier this year. Decline in foreign exchange reserves, reduction in foreign exchange reserves. This is part of kind of a longer trend. This is the IMF slide. There's a couple others that I could have shown, but they all paint the same picture, which is that, over the past decade or two, the dollar share of foreign exchange reserves held by foreign central banks has been declining. I've talked, a lot that as a share of the total gross federal debt, the foreign holdings are going down as a share of the total debt. So it's all kind of part of that same story. Currency depreciation, a sharp decline in the value of the national currency, often leading to inflation or inflation concerns. At the time of this writing, clearly the dollar was down. This is the DXY. So clearly the DXY was down. But I think it's actually more a better illustration of this is gold. So this is the dollar gold cross. And we see that the dollar has been devaluing versus gold, versus real scarce assets for a long time now. So, going back to say, the start of 2024, the dollar's devalued 51% versus gold. I believe if you go back 18 months, it's 60%, 60. So currency depreciation, check. Sharp increase in debt and interest expense. We know this. We've talked about this kind of endlessly. Pro-cyclical 7% of GDP deficit, debt to GDP above 120%, highest since World War II. Interest expense is over 20% of tax receipts, and larger than defense spending. 5 trillion in gross debt increase in the past 2 years alone. So check. We know this. We've been over this. Capital flight, a withdrawal of foreign capital and larger capital repatriation trend, where all the foreign capital that has been pumping into our markets via capital and financial account surpluses, that capital starts to flee. That capital starts to leave those dollar-denominated assets. We've been covering this for actually several months. And so here's a post where, and I think this is still kind of the story, right? During U.S. session, there's not much. It doesn't appear like there's much capital repatriation. But if you're looking at Asia and Europe, right? Remember this move that we were talking about overnight. This was not during U.S. New York session. This was during Asia and Europe, right? And I think that's worth pointing out. This period where equities are down, bonds are down, and the dollar is down. And so that's what we saw here overnight. We've been over that. And so, yeah, this capital repatriation trend we've been talking about since December, January, but it's important to note this has been going on for a while now. And then finally, a rising interest rates, rising yields on government debt. Bear steepener has been at play since early 24 when we first started to warn about long end rates going up with Fed cuts. And sure enough, we know that's exactly what happened. And the curve has steepened. So we talked yesterday about the steepness of the yield curve. Show that. So this is the 2s 10 spread. And we can see that even since recording the video last night, the curve had been starting to steepen even more significantly. Look at the steepening here that we were seeing. Um, just utterly insane. And again, a curve steepening occurs when there's fiscal concerns, when there's fiscal trajectory concerns, when there's debt concerns. This is what a steepening of the yield curve indicates: increased risk for holding duration. And so we had started to see that. Rising interest rates clearly, over the past few days, over the past 3 days, we know that interest rates have skyrocketed higher. Um, uh, it's clearly rising interest rates and the steepening of the yield curve are a check. So, at the time of writing this, you could have maybe said that, one or two of these criteria weren't being met, but today, and I wrote this post March 27th, so I don't know, 2.5 weeks ago. Maybe at the time you could argue one or 2 points, but now I think it's difficult to say that the U.S. does not meet all the criteria of a balance of payments crisis. So, what are some balance of payments crises to look at? Turkey, 2018 to 2020, Greece, the Greek sovereign debt crisis, PIGS, which was Portugal, Ireland, Italy, Germany, and Spain, I believe. Don't quote me on that, but I believe Greece and Spain, sorry. Argentina, the Asian financial crisis in the 90s, and the Mexican tequila crisis also in the 90s. These are moments where other countries have experienced balance of payments crises. So if you're interested, we won't go into it here, but if you're interested, those would be worth studying. And what had got this kind of worm in my brain was this. So March 6th, I was looking at the current account, right? We were talking about the trade deficit blowing out in January. You can see that here in the trade balance. So I was looking at this, and then in this lower pane here, we see the current account plus the Federal Reserve balance sheet, and you can see this very clear correlation here, right? As the trade deficit increases, as the current account deficit gets worse, here, and of course, recently, during those moments, the current account plus the Federal Reserve balance sheet increases. So what is this indicating, this lower pane? This lower pane is indicating that the Federal Reserve balance sheet is offsetting, right, the current account deficit. And these arrows are synced up, so the start of this arrow is the start of this arrow. And you can see this is a very clear correlation. Well, we know the Federal Reserve balance sheet has been, they've been engaged in quantitative tightening, QT. And so the Federal Reserve balance sheet has been falling. Well, what's been happening? The current account deficit has been widening. It's been getting worse. The trade deficit blowing out. So, does this indicate a reversal in the Federal Reserve balance sheet higher in order to support, the value of the dollar, and kind of maintain liquidity conditions? So let's go through a couple things we thought were notable. So again, safe haven trades are the yen, the Swiss franc, and gold. Gold is up big. This is Bitcoin. Bitcoin's up big too. Bitcoin's up 8% today. So that everything is big on up big on the reversal. This was all kind of pre-reversal. Pre-reversal, gold was rallying significantly. Over 1.5%, 2%. So gold was acting as a safe haven. Swiss franc was acting as a safe haven. So here we see, so a decline here means a strengthening of the Swiss franc versus the dollar. And so we're continuing to see that. And we're continuing to see a strengthening of the yen versus the dollar. And I'll remind people that it's pretty insane that the yen is acting as a safe haven. We did predict this. We said to long the yen at, I think, 154. And so that was a pretty good trade, I would say. But yeah, The move index overnight or intraday today. I don't have access to a Bloomberg terminal, but I did see someone that posted that did have access. The move index hit 171. And so this level of the move index. My data has not updated yet, but 171 reading on the move index has only been hit 3 times before. Long-term capital management blowing up, 2008, and Silicon Valley Bank. The 171 reading on the move index is higher than even COVID. And what the 171 roughly indicates is 10 to 12 basis points of movement in treasuries per day, which is just utterly insane. And so I'm sure, volatility might come in a bit from 171. I'll get an update a little bit later. I would guess that it comes in a little bit, but the fact that we are seeing such crazy moves in treasuries is just insane. So want to go over some things. So in a balance of payments crisis, you expect to see equities down, dollar down, bonds down, aka yields up. We have been seeing this for a while now, which was the part of the impetus for writing that post. Clearly today, on the reversal of the tariffs, equities are rallying very hard. Nasdaq's up 10% today. S&P's up 8%. So this is incredible. But I think it's important to go over this because I don't think that this is all over. Clearly, the bond market broke Trump. Clearly, the bond market and a budding balance of payments crisis broke Trump. And so, I don't think that this is all just ends today and it's over. And there's nothing to speak of this again. So I think it's important to go through kind of what a balance of payments crisis is, and what to look out for. And so overnight, I believe that the Treasury, no one knows what the sell-off in Treasuries over the past 3 days. No one knows why. No one can point to one specific cause. I would say it's probably a mix. I would say it's probably a mix of the basis trade unwinding. I would say it's probably a mix of fiscal concerns. And I would also say that it's probably foreigner selling. It's probably, some portion, some part, each of those three things. No one can say exactly what breakdown, what distribution, of those three things it is. But I believe that all three are factors. So what was the basis trade unwind? It was where these hedge funds would go in the repo market. They would get cash, long treasuries, long actual treasury securities, and then short treasury futures. And they'd pick up, a couple basis points, 0.02%. But they would lever that trade up 20, 30, 40, 50x. So it was an insanely levered trade. With a sharp move in the underlying security, right? Remember, when rates move higher, that means the bond is moving lower, and they're long the bond. Volatility introduced the collateral for the entire modern financial system is U.S. Treasury bonds. When they start moving like a penny stock, that increase in volatility is dramatic because this is the collateral. This is the largest market in the world, the most liquid market in the world. When it starts behaving like a penny stock, it has tremendous implications. So that's what the basis trade was. I believe part of the move higher in rates over the past couple days is due to an unwind of that basis trade. And then foreigner selling. I think foreigner selling was certainly part of it. I mean, we just looked at over here. We just looked at the correlation, right? We saw the dollar was moving lower. So we know that as bonds were moving lower, right, as yields were rising and bonds were moving lower. Remember, it's inverse. The dollar is moving lower. So bonds were getting sold and the dollar was getting sold. To me, that indicates someone is selling their treasury holdings. We know the foreigners hold an insane close to $9 trillion of U.S. treasuries. Given the fact that you were escalating a trade war, it makes perfect logical sense that in an era of increasing geopolitical tension, trade tensions, uh, foreigners would not want to hold US Treasuries, especially after what we did in 2022, where we seized Russia's foreign exchange reserves that they were holding in Treasuries. Let's look at the SOFR spread. So I didn't notice this when I did the update yesterday, but I did want to update the SOFR spread. So this is, oops. This is the SOFR Fed Fund spread. And we can see that it moved higher yesterday. It'll be interesting to see where it closes. I've seen some intraday charts that indicate this spread was starting to really blow out. So that's SOFR Fed funds. Let's look at muni bonds. Muni bonds were absolutely puking today. So let's do like the 30-minute. So over the past couple days, they were puking, and then look at this huge gap down. This is the ETF that tracks the muni bonds. This huge gap down, and so it's reversed that on Trump's reversal, but muni bonds were. I think this is something to watch. And treasuries, we've been over the pretty incredible move in treasuries. Like the fact that given the largest negative growth shock since COVID, that treasuries have moved even currently, right? Like even just up until this reversal, 51 basis points on the 10-year is insane. Yields should be falling. People should be buying bonds as a safe haven, meaning yields lower. Maybe you could make the argument that yields stay slightly flat, but they certainly should not be going up 51 basis points. That's an incredible move, no matter how you slice it, in 3 days. That is just utterly insane. In fact, we're higher now than Liberation Day. There's Wednesday close. So we are 25 basis points higher than when Trump announced the largest tariffs in 100 years. To me, there's something notable going on there. Whether it's a basis trade unwind, foreigner selling, just a deleveraging in general. Again, no one can say with certainty, but there is something going on. The bond market was starting to break, and I would argue that this reversal in the tariffs. Sure, the 10-year was up, before that, I think it was around 449. So sure, some bid has come back into treasuries on the reversal of the tariffs just now. But like this thing is still 51 basis points off in the past 3 days, and still higher than when the tariffs were announced. Now, of course, we reversed some of those tariffs, but the important ones are still remaining, which I think that is something I wanted to touch on. So China, goods and services trade deficit. China's goods and services trade deficit, right? Remember, U.S. is mainly a services economy. China's goods and trades deficit accounts for 29% of our total current account deficit. Goods only, or our total worldwide goods and services, goods only account for about 25%. So the fact that we are raising tariffs, sure, we reversed some tariffs on the rest of the world, but a quarter of our trade essentially is done with China, and we run this huge deficit with China. So the fact that we're not only, he not only didn't reverse the China tariffs, but in fact he raised them 125%, and rates are higher. To me, that doesn't make sense in the traditional framing of things. So since Thursday, okay, so inflation. So one of the things people might say is, okay, well, it's higher inflation concerns. Well, on that, we can look at the inflation swaps. So this is the 10-year break-even swap. And we see that since Liberation Day, let's see, Thursday was here. So since Liberation Day, this is what the market is pricing for inflation. They are pricing 6 basis points lower in inflation. Now, of course, this hasn't updated. It has updated Wednesday. Okay, so this is live. So, okay, yeah, it's priced in 6 basis points of disinflation. So you can't say that the move higher in rates is due to inflation concerns, because since Thursday, since the tariffs were announced, um, 10-year break-even inflation swaps are down 6 basis points. So you can't say it's an inflation story. And we can look here. Oh, it's the 10-2. I have this spread of we've mentioned this before. This is the 10-year Treasury rate minus the 10-year break-even swap. So what this indicates is kind of an indication of the real yield, the real rate on U.S. Treasury on the 10-year. And we can see that it's moved sharply higher since this is the 10-year minus the 10-year expected inflation, right? And it's moved sharply higher since Liberation Day. It's moved about 35 basis points higher. So what is that indicating? That's indicating fiscal concerns, at least partly. That's indicating concerns that if the U.S. goes into a recession, yields might rise, like we've been saying for a year, and like we've been seeing for the past couple days. That's indicating a concern over the fact that we have 120-something% debt to GDP. Interest expense is 20%, over 20% of tax receipts. True interest expenses, Luke Groman defines it, mandatory spending basically, is over 100% of tax receipts. So that's defense, interest, Medicare, Medicaid, Social Security is over 100% of revenue. That's what he calls true interest expense. I really like that framework. So what we see in this move in real rates is a concern over the fiscal concerns and the steepening of the yield curve that we've seen. We showed the 10-year, 2-year. This thing moved, higher. The curve steepened, and this indicates, kind of longer term duration risk. So we think that that's very notable. It's also worth noting that we had a 2-year auction yesterday. Thought I had it written down, the size. Oh, I have it here. So yesterday, the 3-year auction was $58 billion in one auction. Again, in these Treasury auctions, it's a Dutch auction. So whatever rate is needed to eat up the entire $58 billion, you got to go you got to the ending rate, the final rate that everyone gets, the final interest rate that everyone gets is whatever the highest rate was that was necessary to eat up the entire 58 billion. And the difference between where the Treasury was trading at the time of the auction and what that interest rate is, required to eat up that supply, that difference is called the tail. And this 58 billion 3-year auction we had yesterday had the third largest tail on record, which indicates horrible demand. I mean, I asked James Lavish for a rating. If I had to guess, he would probably give it a D minus. Just a horrible auction. Today, we had a 39 billion 10-year, and it did go better. The auction today did go better. He would probably give it an A minus. And tomorrow we have a 29 year, 10-month, 30-year auction of 22 billion tomorrow. So that'll be something to watch. The 10-year auction today, the demand, the metrics, the tail, dealer demand, all those were solid today for the 10-year. And what did we see? The 10-year yield is up on the day. So if the fact that the rate is up, given strong demand in the auction, that's not something you want to see. And so that is something that is certainly notable, that the 10-year Treasury yield, despite having a strong auction and despite having this pretty hugely disinflationary, a negative growth shock, despite all that, the 10-year rate is still up. And let's see how much it's up today since the close yesterday. As of now, it's up 12 basis points. That's a pretty significant move in Treasury rates, in the 10-year Treasury rate. And again, the move index would indicate a 10 to 12 basis point per day move in the underlying collateral for the entire financial system. So increased volatility for sure. We'll be seeing that. The VIX was elevated today. I keep doing that. It's clearly come in a lot since the reversal on the tariffs, but the VIX was above 50 today for a good bit of time. You can see 50 here, and it clearly came in on the reversal, but it's still above 30. It'll be interesting to see. Here's a daily. It'll be interesting to see how much lower the VIX gets. But what I think is going on is I think the bond market was clearly breaking. There's really no other explanation for it. The bond market was breaking. The curve was steepening. The long end continues, I would argue, to sell off, um, meaning rates higher. Um, and he had to reverse. The bond market forced his hand, and he knew that if this continued, if foreigners kept dumping, if the basis trade unwind kept unwinding, if the kind of general deleveraging kept occurring, it would cause interest rates to go even higher. Right? The fact that the 10-year was piercing 4.5 when yesterday, just a couple days ago, was at 3.90, like that's insane. It's just insane. If it had continued higher, we mentioned yesterday that it looked like rates were about to break out to the upside. Again, insane. Like there is a world where I'm not sure where that interest rate is. There is a interest rate at which the deficit interest expense blow out, and the US just literally can't afford it. Sure, they can print the money, but then you're in full blown emerging market sort of territory. Sure, the US can always afford it, but the point is that how can you afford it, right? Does it take massive money printing in order to afford it? There is a rate on the Treasury where across the curve there is a rate where things start to go full blown emerging market, Venezuela, Argentina kind of thing. Especially, right, the argument against that is that, well, the U.S. is the reserve currency issuer of the world. Well, but we've established that there's been this capital rotation happening, where foreigners are not demanding the U.S. dollar as a safe haven. In fact, it's the opposite. They are selling out of it. Um, so the argument for the longest time that, well, the U.S. can get away with, right, the exorbitant privilege, the U.S. can get away with what a lot of the rest of the world can't, right? What Venezuela can't, what Argentina can't, what Turkey can't. That argument kind of flies out the window when you see this, when you see dollar weakness, bond weakness, equity weakness, when you see all three moving lower in tandem. um, that is not what you see with the reserve currency issuer. So again, we think it's an important thing to keep an eye on. I don't know where this shakes out from here. Um, I really don't know. This is some of the wildest stuff. Anyone that can tell you that they know where this is headed, it's very uncertain right now. I would say that to bring in China, right? The fact that he reversed tariffs on the rest of the world, but not on China. In fact, he raised tariffs on China. Um, Indicates to me that, like, and this gets to a point we've been bringing up since, I don't know, August or September of 2024, this Mar-a-Lago Accord, this monetary reordering. We were talking about it long before it was cool, before, all these big macro names were talking about it. Because at the time, we saw it as the only way out to truly make America great again, to truly reindustrialize, to truly reshore. We saw that it was, we believed that it was the only way to really truly get to the root of the problem, which is the overvaluation of the dollar and the undervaluation of the yuan, the Chinese currency. So, getting into the Chinese currency, some big stuff happened overnight with that. Um, the CCP ordered the state-owned banks to basically decrease their dollar holdings. Number one. So this kind of gets into the foreign selling of treasuries that we were talking about earlier. That kind of adds some color there. Um, and the other thing that happened is the Chinese, the yuan is a managed currency. it is not like the dollar where it free, quote unquote, freely trades in a quote unquote free market. It is not like that. It is managed by the CCP, and they have what's called a reference rate. And basically, by moving that reference rate, they can. That's kind of the price at which they're fixing the currency versus the dollar. And they moved that interest rate, or sorry, that fixing rate. They moved it higher, which again, remember, U.S. dollar, offshore yuan. That means that the line going up here is a strengthening of the dollar or weakening of the yuan. So they moved that rate higher, and you can see that it hit the yuan. Fell, right? Like this would be what the if you're a Chinese person, right, holding the yuan, this is what the value of your currency looks like, or feels like, I guess you could say. And we saw that it weakened to its lowest level going back as far as my chart goes to 2010. I'm not sure if it was ever lower before that, but certainly lower than the lows here in 22, the low here in 23. And they were indicating, basically we are willing to devalue our currency by up to 30%. This is the amount that the dollar was devalued during COVID. Americans know how painful that was. A 30% devaluation is not a joke. That's a serious devaluation. And the reason they did that, the reason they're indicating they will devalue by up to 30% is it is like we've been talking about since, I don't know, October or November. We predicted that this would happen. We predicted a weakening in the yuan, strengthening of the dollar yuan cross, a weakening of the Chinese currency. And the reason is because that's what happened during the first term. And by doing so, right, this is why there wasn't much inflation during the first round of tariffs in the first term, is that the currency weakened. And that currency move offset any inflationary cost of the tariff. And by doing that, clearly the currency can't offset completely 120 something percent tariff, right? Like we have now. Clearly the currency cannot move that much to fully offset that tariff. But that is what their intention is, right? They are weakening the currency to make it to try and offset the cost of the tariff. Because remember, if you're an export heavy country like China, you actually want a weaker currency in terms of exports, at least. It makes your exports more competitive. This is why, US exports are so uncompetitive, is because, the trade weighted dollar index, the trade weighted dollar index just goes up and to the right forever, right? The dollar is just ever strengthening. So if, for a US manufacturer, a strengthening dollar makes your exports less competitive. So the inverse is true too, where, a weakening of your currency makes exports more competitive for the rest of the world. So all this devaluation talk is getting to that problem, which is, by weakening the currency, they can kind of continue to try and make their exports competitive for the rest of the world. And like, it's important to note, just when that happens, you are taxing. You are not if you believe, let's just say hypothetically, you put a 10% tariff on China, and the Chinese yuan devalues, depreciates by 10% versus the dollar. Americans pay zero extra, zero. Nothing. An American consumer would not feel the impact of that. The currency is moving to offset the cost of the tariff. Who are you taxing? You're not taxing the American consumer by that. You're taxing the Chinese savings, right? Through inflation. And so this is a point we've been harping on for many, many, many months. Back when people were saying these tariffs are so inflationary, we were harping on this point. Tariffs might result in a one-time price increase. But in general, if the currency is moving to offset the cost of the tariff, for at least for an everyday American, they're not feeling any effect from the tariff. They're not paying anything extra. You are directly taxing the Chinese savings. It's pretty incredible, but that is how it works. Now, clearly, like I said, we're not going to see 120 something percent move in the dollar yuan. But the move towards a devaluation, their banning of state-controlled banks holding U.S. dollar assets, all of these things together paint a picture where China is unwilling to reorient their economy towards more domestic consumption. They are continuing, what this indicates is they are continuing their approach of a weak currency in an effort to drive exports, right? Trying to export their way out of deflation. This is what all of these pieces together indicate. They are not willing to try to reorient their economy less export heavy and more domestic consumption. They are unwilling as of now to do that. And I will also point out that the Chinese currency should have been strengthening, um, because China has been, on a fundamental basis, China has been running a huge current account surplus with the rest of the world, like record surpluses. So say under a gold standard, that would what does that really entail if you're running these huge surpluses? Well, say under a gold standard, gold is flowing into your country, right? Because you are consuming less value than you are producing. So gold flows into your country, increasing gold stocks in your country. This is increased wealth. This is increased collateral for money. This is increased kind of monetary base, right? Stimulation. The economy stimulates, um, and the currency is strengthened, right? But what have we seen with this kind of these record trade surpluses out of China? We've seen the currency weaken, right? Meanwhile, you have the dollar, which has strengthened when the US runs huge, utterly insane twin deficits. This is totally backwards. The Chinese currency should be strengthening versus the dollar. And this is why we started talking about the Mar-a-Lago Accord in September, October of last year. We realized that this is kind of the only way out. Tariffs alone will not fix the imbalances that the US has. We also would point out that the dollar is broken. The currency should move to offset trade imbalances, but we know that due to the reserve currency status of the dollar and dollar-denominated assets, it kind of puts this bid under the dollar, right? So the dollar becomes overvalued, and the currency is not able to move properly, right? To weaken to offset the trade imbalance. And so the only way you address that is, number one, by ending the reserve currency status of the dollar, and finally addressing Triffin's dilemma, which is that by being the reserve currency issuer of the world, you must run ever increasing deficits to get your currency to the rest of the world that needs it. And there will be, your currency will strengthen, right? Which further and further and further makes U.S. manufacturing, U.S. exports more and more uncompetitive. Well, what happens as U.S. exports become more and more uncompetitive? The trade deficit widens, right? So it becomes a vicious cycle if you're a U.S. manufacturer. It's a virtuous cycle if you're in financial assets, because those trade deficit dollars that get shipped out to the rest of the world must flow back into the capital and financial account, right? This is a dynamic we've talked about, and I'll link to a video that goes through this in more detail. This is a super critical concept to understand. The trade deficit, say it's $130 billion a month, that means that just on an international accounting, international finance, just basic international accounting, flows basis, $130 billion a month trade deficit, that means $130 billion of capital must flow in to US markets. $130 billion a month. And of course, this gets to hyperfinancialization and overvaluation of US stocks and a lot of the things, right? Increasing wealth inequality, all of the things that we've kind of been talking about for a long time. And the way you address this is, number one, by ending that, by addressing Triffin's dilemma and ending the reserve currency status of the dollar. We can see that through the past couple weeks, tariffs alone have not really been working. Now, of course, it's very early days, but like we see that the Chinese currency or the CCP can just go, okay, well, you put a 30% tariff on us, we'll devalue our currency by 30%, right? It gets you into you realize, okay, tariffs alone were never going to fix this because of the devaluation of the Chinese currency. That is their playbook. Just perpetually devalue their currency to make their exports more and more competitive. And so how do you address it? Well, Mar-a-Lago Accord. This is where, Plaza Accord, Bretton Woods, all these kind of global monetary reorderings. Scott Bessent mentioned it 3 times in his speech at the Manhattan Institute. Stephen Moran wrote an entire paper, User's Guide to Restructuring Global Trade. And I will point out, Stephen Moran gave a speech 2 or 3 days ago where it reads like a post of mine from 9 months ago. Like any number of, half a dozen posts that I had made talking about Triffin's dilemma and twin deficits and, kind of an overvalued currency and, right, the same exact concepts I've been harping on, yelling, screaming from the rooftops for so long. I was reading them on the whitehouse.gov website. Coming out of the chairman of the Council of Economic Advisors, stuff, words I've been saying for a year. So that was kind of trippy, I must admit. And so, yeah, so you get into this situation where the only way is to, a monetary reordering where you get all the countries together. You say, hey, we all have an insane amount of debt. Our fiat currencies, we are all in debt up to our eyeballs. We are all over leveraged. And you, right, China, your currency is too weak. So we want your currency should be much stronger. We want your currency stronger versus the dollar. We want the dollar weaker versus your currency. And Europe, your currency, right? And all these countries get together and they do that and they fight it out, right? Because every country has its own interest. China, for example, their whole approach is to export, just dump on the rest of the world, dump exports on the rest of the world, export deflation, export their way out of deflation. So like that is China's approach. So, they're going to have their own interests. Stephen Moran and Bessent and Trump, need a weaker dollar for U.S. exports to be competitive. They have their interests, right? Everyone has competing interests. But the point of a monetary reordering of a Mar-a-Lago Accord is to get everyone together and kind of come up with like, okay, we got to agree that it's what we have now is not working. So what I believe a Mar-a-Lago Accord will look like, I believe pretty much all developed fiat currencies will be devalued versus gold, devalued versus Bitcoin, and the yuan will be strengthened versus the dollar. The dollar will be weakened versus the Chinese currency. That's kind of I think the main point. There might be other notable, crosses, currency crosses that end up changing in a Mar-a-Lago Accord. But really, I think those are the 2 main points. Everything gets devalued versus gold and Bitcoin. And the yuan is strengthened versus the dollar. I think those are the 2 critical points. When people talk about the Mar-a-Lago Accord, I think that's like 80%, right? The yuan and all currencies being devalued versus scarce assets, real good scarce assets. I think those are the 2 main points. And I think that, what we've seen over the past couple days just kind of indicates that this is where things are headed. The fact, let's check back in on Treasury, see how they're doing. Yeah, they're still getting sold. So, I just do, the past couple days have kind of confirmed or strengthened my belief that a Mar-a-Lago Accord is really the only viable kind of end solution here. We've seen this capital rotation. We've seen bonds, long-term treasuries just puking, yields going, much, much higher, sharply higher. Meanwhile, the dollar is selling off and equities are selling off. Like we went through earlier, we meet all the conditions for a balance of payments crisis. And so I think that is where things are headed. I think the Mar-a-Lago Accord is kind of where things are going to be headed. Let's see if there's anything else to mention. Crude made a huge reversal. We're not sure where this goes from here. I don't really have a direction on this, but crude is moving sharply higher. We went over gold, Bitcoin. There's so much going on. Treasury general account. I wanted to flag the Treasury general account. There has been this huge move lower in the Treasury general account. And I haven't really heard anyone talking about this. So from the 10th of February, the Treasury general account has been ran down by $465 billion. That's a lot of money. And that is, liquidity into the system. And now, Bet was part of that Besant trying to support the Treasury market. Who really knows? But that is a large move in the Treasury general account that normally has pro liquidity component to it. Meaning, everything does well. We know clearly everything has not done very well. And so we did want to flag that. Yeah, the swaps are not worried about inflation. I think that's worth reiterating. Oh, and rates across the world. This is the UK government 10-year, the gilt 10-year yield, and it's higher than the LDI crisis of 2022. Um, I think the US was setting up for a Liz Truss moment, very similar to what the UK saw here, where um, the 10-year rate moved, I think it was like 110 basis points in a couple days. I think the US was shaping up for something like that. But you can see the 10-year yield in England has been moving higher over the past week. Here, we'll go to the daily, so it's a little bit easier to go handle. So yeah, the past 3 days, Canada has also seen it. Australia has also seen it. This is the daily for what we were just looking at. Gilts have moved higher. Germany stayed about flat. France has moved marginally higher. Spain moved higher. Japan is notable. So over the past 3 days, we've seen yields actually move higher on the Japanese government 10-year bond after this huge reversal. And part of the reason for our long yen thesis was an increasing of the interest rate differential. Japan is one of the few countries that has strong income growth and wage growth and aggregate economic growth versus the U.S. is one of the few countries where the interest rate differential could actually widen. So we think that's worth noting. The rates were higher, across not just the U.S. but Canada, Australia, and England, and marginally in parts of Europe. So yeah, this we'll watch the auction tomorrow. We'll watch the S&P. It did fill that gap. It did fill this gap here. There's still this big gap up here at 554. It did fill this gap. Whether or not it can make it all the way up there, who knows? This is a very headline-driven market, very volatile VIX, right, in the MOVE index. There's a lot going on. Hopefully, this was helpful in at least, explaining what a balance of payments crisis is, maybe getting through some of the Mar-a-Lago Accord. Hopefully that was somewhat helpful. Everyone's talking about it now. So, it's worth, I think, worth defining what that will actually look like. And again, we will continue to watch this story, which is the dollar 10-year, the longer term bond rates. This is probably going to paint the picture. I mean, the fact that the 10-year is still up on the day by 10, 11 basis points is pretty incredible. So rates should not be moving higher based on inflation. Again, we will say it a third time. This is the 10-year break-even swap here, and right since tariffs were announced, they are lower. So the market is pricing in less inflation than when when the tariffs were announced. Less inflation, not more. Certainly not 50 basis points more, but 6 or 7 basis points less. So again, it's definitely not a higher growth, higher inflation, higher nominal growth, higher inflation. I really don't see the evidence for that. And spreads will be another thing to watch. Spreads have been blowing out. And so that high yield spreads will be important to watch. LQD HYG spread came in a good amount today. And especially on the news of the reversal of the tariffs, they came in huge. So that's a good sign, for the American economy in terms of dysfunction and things starting to break. High yield spreads coming in like this is good. But yeah, there's a lot going on, a lot to watch. We still think the rates are the big story. Hopefully, this was somewhat helpful. Uh, Hopefully, there's a lot going on. I know I didn't get to everything, but hopefully that covered most of it. And yeah, we'll catch you later.